I'm Morella Fernandez. Thanks for joining us here on Market Call. Andrew Moffs is on the show today. He's Senior Vice President, Portfolio Manager at Vision Capital. He's going to take your questions today on real estate stocks. Here's how to reach us. Call us toll free, 1-855-326-6266. You can also send an email for us, marketcall@bnnbloomberg.ca. Andrew, thanks for joining us today.
Thanks very much for having me.
So investors, as you know, have been scrambling, trying to look for a safe place to put their money. I'm wondering, with the trade war and everything that's happened, has this benefited real estate stocks?
It's certainly a future benefit for the space overall. Today, when you look across equities and you see uncertainty, you see a large underweight across equities, particularly in real estate stocks. As that uncertainty continues, I think people are going to be looking more for defensive equities to invest in, and we think the publicly traded real estate space is the absolute beneficiary of this. It's been a sector that's been completely underweight by generalists for the past couple of years since interest rates went higher. But in contrast, when you look at the private markets, real estate fundamentals in the commercial real estate space have been quite strong. You see internal growth of 3-4%. You see balance sheets in check. And I think given the interest rate backdrop, which we can get into, I think transactions will pick up at quite a pace in the back half of this year, and that will shed a light on the valuation disconnect in the public market. So we're actually quite a bit bullish looking at the outlook for the rest of this year.
Okay, and are you talking about Canada and the U.S.?
We're talking about both. Certainly, there's definitely a difference between the two countries. I think right now people are translating slowdown in the United States into recession. I don't necessarily think that might be the case. I think you have a stronger economic backdrop there. Without a doubt, the backdrop in Canada is tougher, and the tariffs do not help that backdrop, and recession could be a reality. All that means, the central bank here in Canada, they're going to be cutting at the fastest rate of any country globally. And that type of backdrop for interest rates can be quite positive for the valuation of real estate, and particularly positive for those that have a better cost of capital. I think this is the environment where people can take advantage of not necessarily broken assets, but broken owners, and buy great assets. Plus, if you see assets continue to trade at such a wide discount in the public markets, this is definitely the type of environment where we could see M&A pick up, and we can see privatizations across the REIT universe in Canada.
So are you seeing the money, or where are you looking at specifically, money invested in retail property space or rental home stocks? It's a great question, because it's sector by sector, and as a stock picker, you really want to get the top down correct and then go bottom up. And what we try and do at Vision is buy real estate trading at a discount in the public markets relative to the private markets. So when you look across the different sectors where we are bullish, if you're thinking recession, and it's kind of how can you be bullish at the same time as recession? You want to think defensive. So think about grocery anchored shopping centers across Canada, where it's very defensive. People need to go to the grocery store. They need to go to the pharmacy. Or think about sectors where there's a secular tailwind, like seniors housing, where the demand is going to far outpace any new supply that could come to the sector. We think those two asset classes, for example, are great sectors to be invested in today. You do want to shy away from sectors like office space. That has a secular headwind against it and high vacancies, and we don't think there'll be any rent uplifts anytime soon there. Got it. All right. We are going to take a break to line up your phone calls. Andrew Moffs is Senior Vice President, Portfolio Manager at Vision Capital. He's taking your questions today on real estate stocks. Here's how to reach us. We're back in a moment. Welcome back to Market Call. Thanks for joining us today. We want to head right to your questions, and Ed has written in an email for Andrew to answer. Ed wrote in from Calgary saying, what is your opinion on owning SmartCentres REIT? And we'll turn that over to Andrew.
So SmartCentres REIT has a portfolio of open-air shopping centers across Canada. Its main anchor is Walmart. So hence, it's a very defensive income profile. The flip side of being very defensive and having such a large tenant concentration is that the internal rent growth of this REIT is quite low. So what we see is below average FFO growth when you compare this to some of its peers. At a time where it has higher than average debt maturities. So we don't see a lot of earnings growth in this vehicle. And at a time where, though it has an attractive distribution yield, likely in the low 7% range, it has a very high payout ratio. And what that is the amount of cash flow there is to cover those distributions. So there isn't a lot of leeway there. Not necessarily saying it's a negative, but we don't see a lot of growth. And today, when you're looking at an economy where things might be more difficult, you want to have a bit more defensiveness and have a bit of slack. And you don't necessarily get that in SmartCentres. So if you own it, you're holding it for the yield. We think there's perhaps some better opportunities for growth elsewhere in the retail space.
So just to follow up on something you mentioned earlier, you were saying if you want to invest typically in a difficult time for the economy, you want an area, if in a retail space that's anchored by a grocery store where people have to go, they can't sort of turn away from groceries. Would you consider Walmart now in the grocery store category?
Yeah, by and large, commercial real estate landlords do consider Walmart as operating in the grocery space, and they've done a better and better job of it. They do have obviously a higher percentage of general merchandise than other more pure play grocers and have a much larger box. But it's less about the question about Walmart, it's about the rest of the inline tenants. When you look at the typical Walmart anchored shopping center, you'll find other large format general merchandise tenants, more fashion, for example. Whereas we're looking at more, when I talk about defensive grocery anchored shopping centers, we're thinking more neighborhood, urban, smaller centers. That is the typical trip to the corner to go get your groceries, get a haircut, things you can't do online.
Yeah, more of a strip mall kind of idea, I guess.
Correct.
Got it. Okay, let's go to the phones. Glenn's on the line. He's calling from Collingwood in Ontario. Hi, Glenn.
Good afternoon. Andrew, I see Morgard Corp has just released its annual report with an NAV of $400. Is this something I should just put away for my grandkids? Thanks for your comments.
Certainly, Morgard has always been a store of value where we see the net asset value, which you've referenced, materially higher than the share price. For many years, it was a core holding of our funds because we saw that net asset value increasing, and hence we thought the share price would follow. Not necessarily close the gap because we couldn't identify a catalyst that would close it. Today, however, I think you're in this bit of an environment where we don't necessarily see Morgard's NAV increasing. So you have to appreciate and understand that the discount will continue. And so why is that? Its asset base is principally retail and office, two sectors that are somewhat out of favor because their retail more tilts more to the enclosed mall profile, and hence they have exposure to Hudson's Bay, for example. Their earnings growth potential isn't as great sitting here today. They have higher than average cost of debt. They have a large debt maturity coming next year with a high coupon attached to it. So certainly, I think you have a lot of cushion to the downside because of the large discount to net asset value. I'm not sure today is the right time to be necessarily pursuing a new position in Morgard, since we find there's better opportunities elsewhere.
Got it. Okay, let's go back to the phone lines. And Elliot is on the line. He's calling from Hamilton, Ontario. Hi, Elliot. What's your question today for Andrew?
Good afternoon. Mainstreet Equity down about 10% from its highs. Is this a company-specific issue, or is this investors worried about that Albertans will not be able to pay ever-increasing rents? Thank you.
Tell me about Mainstreet, Andrew.
Yeah, this is a great little company. We like it a lot. We own it in the fund today. It is a corporation, not a REIT. It is a company that owns multifamily units focused in Western Canada. They own about 18,000 suites with a concentration in Alberta, about half, maybe 55% of its portfolio, British Columbia, about a quarter of its portfolio, as well as Saskatchewan and Manitoba. Certain markets, they actually have a huge market share. I think Surrey, they have about 28% market share, Abbotsford, 21%.
So what's the point? These markets are non-regulated markets, meaning there's an ability to capture the mark-to-market in rents more easily than rent-controlled markets. This is a company that has never diluted its shareholders. It has been able to grow using capital in an accretive manner. They have a buy, fix, rent, and repeat kind of model, which they call the Mainstreet value chain. And they've been doing there's just been great execution of it. The stock has come off its highs. It actually held in quite a bit better than its peers that are structured as REITs. Sitting here today, I think there was some concern that Alberta might not be able to withstand some of the rent increases that apartment landlords have been able to push on to renters. We think it's a bit unwarranted. We see Alberta as one of the most affordable rental markets in Canada, and we see population growth growing at a greater level than the national average. So I think there's a great opportunity to look at this company, given the value inherent in it as it trades at a discount to net asset value.
Got it. Okay, let's move to our next caller, Gordon from Victoria, BC. Hi, Gordon.
Good morning. Plaza REIT, a great record of adding value to and intensifying properties, but the longtime CEO recently retired. What are your thoughts moving forward?
So yes, you are correct. Michael Zakuta is no longer the CEO of the company. We think very highly of him, but also think highly of their management team. They've done a very good job in terms of managing this portfolio that's concentrated primarily in Eastern and Atlantic Canada. This does fit more of that grocery-anchored profile I've been talking about. It is a small cap REIT, so hence doesn't always trade efficiently. That can be an opportunity at certain times. It does have a very attractive 7+% distribution yield and trading at a pretty high implied cap rate. An implied cap rate is the inverse of a multiple. Basically, it's the yield one, just like a bond, it's the cash flow yield that one assumes when they purchase real estate. So we think it's an attractive REIT trading at a discount to NAV. Is it the most attractive discount? No. We see some other opportunities elsewhere, but I see a decent upside scenario in this stock today.
Comparably, they only own about 70 properties, Andrew?
That's right. It is a very concentrated, small portfolio. They did a great job of curating this portfolio. They typically would buy assets that needed some value add development or ground up development or better leasing, and they've done a great job of operating this portfolio from a very small base.
Got it. Okay, we do have to take a quick break. Andrew Moffs is going to stick around to answer your questions today. We're back in a moment on Market Call. Welcome back, and thanks again for joining us on Market Call. We want to go right to your phone calls. Mike is on the line. He's calling from Toronto with a question for Andrew. Hi, Mike. What is your question today?
Hi. Can I ask about Sienna Senior Living? I've got a little bit that I've done well on. Do you think it's still a good hold or an add, or should I look at something else like a Chartwell or an Extendicare?
Andrew, where do you land in this space?
Yeah, so first of all, we love this space. Sienna Senior Living is a core holding in our funds. We are positive on it, and I wouldn't be shy of adding to it here. This fits two buckets. First of all, the profile of Sienna is more defensive in that about half its portfolio is in the long-term care sector, principally in Ontario, where you have a 50,000 person wait list just to enter a nursing home. And the rents are paid for by the Ontario government. So you're effectively getting government credit. On the other side of the portfolio, in the retirement home sector, they have done a really nice job of creating and growing a retirement home portfolio. And the demographics today in the retirement space are so compelling. The seniors cohort, 80 plus years of age and higher, will be growing at a compounded annual growth rate of over 4% over the next 20 years. At the same time, supply will be barely 1% of inventory. So you have, anytime you have a mismatch between demand and supply, that's typically a positive in any business, of course, in real estate. So we look here today, Sienna is on a path towards 95% occupancy in its portfolio. We think you'll see great cash flow growth. At the same time,
They are doing a great job on the long-term care redevelopment side, moving Class C beds into Class A beds and getting the per diem uplift from the Ontario government. So we think it's a company with a great cost of capital growing today, and we love both the growth profile as well as the defensive characteristics of the sector.
Just as sort of an added question, I'm wondering how much you have to put in when you build these homes infrastructure-wise, because you're building for a very specific part of the population. You require high levels of care and high levels of infrastructure within each building. Does that sort of make a difference how much they're putting into what investors are likely to get out of it?
They are, when you're pursuing any type of development, you have to have a great handle on your cost. And in this situation, they have a perfect handle in terms of the demand side. I already reflected that in terms of firstly, if they're replacing Class C beds with Class A beds, it's pretty obvious you already have a guaranteed income stream. But we do know that there's a 50,000 person wait list. The Ontario government has increased funding. So what they do is they provide a construction supplement and a per diem reimbursement level, such that to entice development of this space, because we are so desperate for quality beds. So when Sienna steps into a new development, they already have the cost underwritten. They have the land already tucked away. They know what to budget, and they'll typically enter into fixed cost contracts, as well as knowing that on the back end, they'll have the subsidy from the government as well as the return stream. So we actually think this is a very low risk type of development, so long as you get the numbers penciling day one. And up until very recently, and I mean last year, you really haven't been able to see the numbers pencil. So I think the government has gone a long way to help this sector provide the beds that are so badly needed.
Interesting. Okay, let's go back to the phone lines. John's on the line from Kingston, Ontario. John, what's your question today?
Yes. Hi, Morella and Mike. It's on Allied Properties. I've held it for a couple of years now, and I wonder if the dividend is safe or not. Tell me what you think about it. Thank you.
Okay, Allied Properties.
Yeah, that's a difficult one. The financial results recently reflect a very challenged operating environment, and it continues. If you looked at their fourth quarter earnings, the results were below expectations. I think FFO, funds from operations, were down about 13% year over year. Why is that happening? They're experiencing interest rate headwinds. They're seeing their internal growth go negative. Same-store NOI was negative due to greater vacancy in their portfolio, as well as they had a partnership with a troubled operator, Westbank, whereby they were providing loans to this developer. And what they've now entered into a transaction where they took on the assets and now are no longer receiving that high income from those mezzanine loans. So you see a bit of an earnings headwind at a time where the greater backdrop for office space, and again, Allied owns office buildings across Canada, good buildings, but suffering from a very challenged office market. So you're sitting here today, their portfolio is just under 86% occupied. Allied is telling the market they can get to 90% occupied by year end. An ambitious goal because it will require a lot of leasing in a market that has been absent of a lot of leasing. Particularly, we're seeing a lot of new supply in one of their key markets in Toronto. So the caller asked about the distribution. Right now, the payout ratio is hovering around 100%. But if you adjust for capitalized interest, i.e. non-cash revenues, they don't cover their distribution. The company's been very adamant that they are not cutting the distribution, that they're willing to fund the shortfall through borrowings. We don't necessarily see that as a formula for success. And I would personally be concerned about their ability to maintain the distribution. So if you're investing for the yield, I think that's probably not the right path here. If you're making an investment in Allied today, you have a bullish view on the long-term prospects and their near-term leasing probabilities.
Got it. Okay, let's move on then. Dominic's on the line from Montreal and has a question today. Hi, Dominic.
Yes, hello. Thanks for taking my call. I'm looking at two ETFs, and I would like to have your insight. My goals are defense, so very safe, but at the same time, I like to have a good, total return, distribution, and growth. I wonder what you think of Choice Properties and RioCan I'm sorry, not RioCan, but Canadian Apartment REIT. What you may think with those goals in mind. Thank you.
Okay. Yeah, so these are two different REITs. Choice Properties REIT is the principal landlord for Loblaws grocery stores across Canada. Canadian Apartment REIT is the largest apartment landlord across Canada in the publicly traded space. Two very different sectors. Choice is a far more defensive portfolio, and if that's what you're looking for, I think the conversation can begin and end there. I think they have a great portfolio. About 20, and I should add, about 20% of its portfolio is in the industrial warehouse space, where I'm quite bullish on that sector across Canada. When you look at Canadian Apartment REIT, I think what one has to focus on when they're investing in multifamily today in Canada, you have to think about affordability, and you have to think about how defensive is the tenant base, and how defensive is the cash flow from that tenant base. And Canadian Apartment REIT has a great portfolio. They do have a higher concentration in Ontario. And if we are concerned about tariffs and potential job losses in our strong manufacturing base, that typically affects Southwestern Ontario, where CAPREIT has a concentration. So we think there's better opportunities in the multifamily space today to allocate dollars, and we can talk about that later in the show. So if I were to choose between the two, if you're looking for defense, I think Choice is probably your better bet.
Yeah, there's definitely a lot of investments along the campaign trail having to do with housing, so it would be interesting to have that as part of the conversation. We're going to take a quick break right now. When we come back, we'll have a look at Andrew's past picks. That's next. Welcome back. Time to take a look at the past picks that Andrew chose March 27th of last year, 2024, so a year ago. At the time, you picked Dream Industrial REIT on the TSX, which handles industrial spaces. It was at the time $13.12, now down to $11.34, so a dropped return of 14%, 8% total return. What happened with Dream?
Yeah, so this is a stock, it's actually one of our favorite stocks in the industrial space, just because it's so inexpensive today. Stock had been doing quite well. It hit about $14.50 in September. Why? Because the fundamentals in its markets, in the industrial warehouse markets in Canada and Europe, have been so favorable and so strong, and they were on a path to close the gap with its NAV, which is more in the $16, $17 range. I think concern over tariffs principally hit this stock. People think about global trade, how it'll affect industrial warehouse. We think Dream Industrial is well insulated from any of those concerns, as it really serves the last mile, which is very much in demand of e-commerce tenants today. They have a 25% mark to market in their portfolio, meaning the rents are far below market rents today. And so if we never have a market rent growth again, you could still see internal growth in earnings for this REIT. Now, market rents have been growing about 10% over the past 2 years, so we're not concerned about that. They also have a very attractive development pipeline, so we think the risk reward is really to the upside in Dream Industrial today. The market's implying 0% in terms of that mark to market, and we think it's completely unwarranted.
So basically, you would hold.
Absolutely, and I think this is a great opportunity to be adding to this stock.
Got it. Okay, let's go to your second past pick from March of last year, which was Chartwell Retirement Residences, CSHUN, recommended at $12.35 at the time, now to $16.70, so a 35% upside return, 40% total return. Chartwell, of course, retirement homes, and clearly they've been doing well.
Absolutely. I've talked a lot about this space so far. Chartwell is the leading platform in Canada. They have a national brand, 29,000 suites. They're 91% occupied in the retirement home space in Canada. They believe they will also get to 95% occupied by year end. And if you think about the internal growth based on that, it is very high margin growth once you're already above 90% occupancy. So this coupled with very strong liquidity, they're in a great position to be adding to their portfolio in an accretive manner. So you can enjoy both strong internal growth as well as strong external growth.
And we think there's still a lot of upside in this stock. I think the market will be surprised come first quarter when they report their earnings, what they've been able to do with their balance sheet. I mean, typically people expect this company to come back to the market and raise a lot of equity. They have put in place an at-the-market program where they can just issue shares into the market directly during the trading day, and I wouldn't be surprised if they haven't taken advantage of some of the strength to raise some equity capital to reinvest and buy some new assets. So I think it's a really interesting time to be owning the stock today.
Got it. Okay, let's move to your third pick from March of last year. First Industrial Realty Trust at the time was 52.07 American, now up to 53.76. So a 3% upside return, total return of 6%. Tell me about First Industrial.
Yeah, so First Industrial, they own about 70 million square feet of industrial warehouse assets across key distribution markets in the United States. We were bullish on this space. It's a $9 billion market cap. We thought this REIT traded at a very attractive discount to net asset value. We thought that net asset value was in the $58 range. The stock got very close to it, if not hit it. Earlier last year, as well as into this year, we took the opportunity to exit at what was about a 15% total return. And we've reallocated those proceeds to other investments in the warehouse space that trade at a discount.
Got it. Okay, we have to take a quick break. Andrew Moff sticking around to take more of your questions when we come back. Stay tuned. Welcome back. We have Andrew Moffs joining us to answer your questions today. Caller Rose is on the line from Cambridge in Ontario. Hi, Rose. What is your question?
Oh, good afternoon. Analysts bring up Prologis a lot because it's data center build-out, I think. What do you think of the rest of their holdings, and what price can I buy this at so I can get a bit of upside? They did just increase their dividend, which I liked, because a lot of my REIT don't. Or is this the best kind of industrial REIT I can get in the States? Thank you, Andrew. You're one of my favorites. Bye-bye.
Thanks, Rose. So Prologis is international. They have industrial spaces outside of North America as well.
That's right, and thanks very much for the call. So Prologis, first of all, it's the largest REIT, period, over $100 billion in market cap. I think about 80% of its portfolio is North America, and that's really concentrated in the United States. They have a smaller they are one of the largest landlords in Canada, but it's pales in comparison to the rest of their portfolio. Today, I think, first of all, a great entry point in Prologis is probably around $100. The stock's trading at a low 5% implied cap rate, which is pretty fair. There is a bit of risk in this name, as it is the global player. So if you're concerned about a coordinated global slowdown in terms of trade, it will likely hit Prologis first. That said, it is such a great company. It's just a very impressive management team, a very impressive platform. They have moved to look into data centers. Right now, they're just using their platform to develop data centers and sell them, but some are arguing perhaps they should invest and hold on to them more long term. If you're looking for an investment in industrial warehouse focused in the United States, I would guide you to a company called EastGroup. The ticker is EGP. And why we like it, it is smaller format industrial, small boxes in the U.S. Sunbelt, where we see population growth and we see it benefiting from e-commerce trends and less susceptible to larger global trade, as well as the high new construction pipeline we've seen in the U.S., where there's been a lot of new supply in those 500,000 million square foot boxes. EastGroup, just like Dream Industrial here in Canada, is more concentrated in that 100,000 and smaller square foot box.
Got it. All right, Andrew, let's go to Sal. Sal's on the line from Toronto now. Hi, Sal.
Hi there. Yeah, my question is on Granite REIT. I was wondering, I was looking in the industrial space, and this one caught my eye, but it's kind of depressed right now. So I was wondering if this would be a good time to jump in, or better to sit back and wait a little bit till things clear up. Thanks so much.
Andrew, what do you know about Granite REIT?
So Granite REIT owns an industrial portfolio in Canada, the United States, in Europe. We think highly of the management team. These are good assets. The headwind to Granite today is twofold. And hence, I would recommend, if you're looking for exposure, pursuing something more along the lines of Dream Industrial, or I just mentioned EastGroup. But I'd say the two headwinds, one is its largest tenant, and this is dates back to its inception, is Magna, the auto parts manufacturer. They own very good assets. They own a huge facility in Graz, Austria, for example, where they assemble vehicles. Just given tariff headwinds, when you have such a large exposure to an automaker, and this is over 25% exposure, that's a headwind at least the market doesn't want to deal with. And though we don't necessarily think it's going to be a risk in terms of the cash flows, I think there's a question in terms of the value of the assets underlying. The second headwind is some of their concentration in the U.S. They have more of a Midwest focus, markets like Columbus and Indianapolis, where we've seen a higher level of new supply and hence a lower level of rent growth. Today, Granite has some vacancy in those markets, and so they are having a bit more of a tough time leasing up those assets. And so with those two headwinds currently, I think it's a stock you probably want to wait and find a better entry point, or at least when those two things clear on the horizon.
Got it. Okay, Joe's on the line now from Sarnia with a question. Joe, what's your question today?
Good afternoon, Marilla. I just wanted to circle back on Andrew's point about property use being an important criteria when you're looking at investing in REITs. And consequently, I'd like his opinion or assessment of Northwest healthcare properties. I kind of like their space. In terms of focusing on doctors' offices and medical clinics, that kind of thing. And the yield is 7+%. I'd like Andrew's opinion. I'll hang up and listen.
Thank you.
Yeah, I tend to agree with the caller. I do like the space. Northwest Health is a global healthcare REIT. They own a diversified array of healthcare assets that focus on hospitals, medical office buildings globally.
Why have they dropped? I'm sorry to interrupt, but why have they dropped so much from 2023?
Yeah, capital allocation decisions finally caught up to them. They are in many countries globally. They had the wrong balance sheet in terms of expanding into these countries. So picture buying Brazilian hospitals with Canadian unsecured debentures. They weren't necessarily fixing the currency. And they also were very competitive in terms of asset prices they paid for assets in the United Kingdom, for example, without having a partner on the other end to take it out. So they got into a bit of a liquidity crunch. We had a management shakeup. A CEO came in to begin the cleanup. He's done a respectable job. Unfortunately, he's announced he's going to retire in the mid part of this year. So though it has a very attractive distribution yield, it's always questionable entering into a company that's going through restructuring without permanent leadership when it's questionable whether the dividend can be sustained. And hence, I wouldn't be investing for that attractive distribution yield. It might be at risk. And though I do like the space, I think there's too many questions on the horizon in terms of if we're looking for safety today, though I like the asset class, I don't necessarily know this is the best way to express it.
All right, Joe, I hope that helped you out, gave you some information you can use. Andrew Moffs sticking around. We have one more block of questions coming up. Stay tuned. Welcome back. Let's go right to the phone lines. Rob's been holding on the line from Calgary with his question. Hi, Rob.
Hi, thanks for taking my call. Andrew, you've spoken to both Sienna Seniors Living and Chartwell Retirement. I'm wondering, what's your opinion on the third leg of the seniors home stool, Extendicare? Would you be a buyer of Extendicare today, or would you prefer one of the others? Thanks again, and have a great day.
Andrew, just out of curiosity, do many of these go right across country with properties, or do they tend to focus on just a couple of provinces?
tend to focus on just a couple of provinces. If it's long-term care, it's often in Ontario, where there's a very defined model that has historically worked for a lot of the operators, and you see that in Extendicare. So Extendicare, they're a Canadian-listed healthcare company focused on long-term care in Ontario and Alberta, and as well as they have a home healthcare business just in Ontario. So much so that business is about half of the business today overall of Extendicare. So less a real estate business, more of a home healthcare business on the services side. This stock's done really well, and if you own it, you've done well. You can continue to hold on to it and collect the yield, though I think it's now south of 4%. There's probably a better entry point in this stock, and if there's a pullback, it might be bought. You have to take a strong view on the home healthcare business today. I'm pretty bullish, as you know, on the long-term care side as well as the retirement home side. They no longer have a retirement home exposure. So you have to make a bet that this company can do a good job in terms of either rolling up smaller home healthcare companies or improving the margins thereof. And we haven't had a long track record in the public markets within the sector to make a good assessment of that. And the market certainly rewarded them so far in terms of having a better cost of capital. So I would wait for a pullback if I were looking to add to this name.
Got it. Okay. Let's go to the phone line because Richard has been holding as well. He's calling from Toronto. Richard, what is your question today?
My question is, I would like to ask Andrew what his opinion is on Minto. I've held it for a few years, and I've been a little bit disappointed with it.
Okay, let's get to Minto.
Yeah, Minto Apartment REIT, they own apartment units across Canada, focused Ontario, Quebec, British Columbia, Alberta. It has been disappointing as a REIT. They had a very successful IPO, did very well, had subsequent successful equity offerings, but has since traded at a material discount to their IFRS valuations, to their net asset value. And this began in 2022. There was some disappointment in terms of how they were allocating capital between the parent company Minto Group and the REIT. And sitting here today, that discount is just too wide. The question is, how can they close that discount? Some wonder, could the REIT be privatized? Could they sell assets? And I think the management team is taking steps today to help close that gap. They've done something they hadn't done prior. They're buying back units in the REIT, which we always think is a bullish indicator for any company and a prudent use of capital when you're trading at a discount. I think your downside is definitely tilted to the upside. That said, the operating environment is a lot tougher today. And so the other thing that Minto has suffered from is some new supply as Minto's portfolio tilts more to the luxury side. So in Toronto, for example, they have a lot of new competition facing some of their assets, and hence they haven't been able to enjoy the same level of internal growth that they did previously. So if not for the faint of heart, but you could continue, you can continue to hold on and look for them to close that gap. And I think they're helping you by buying back units today.
Okay, we do want to get to one more phone call. John is on the line from London, Ontario. I think we did touch on what he's about to ask, but we'll see what follow-up question you might have. Hi, John.
Hello, Marella. Hello, Andrew. My question is on Dream Residential REIT. I've owned it since inception in the setting of higher immigration and therefore higher need for residential units. Is it a hold here, or should I switch these assets to Chartwell? Thanks very much.
That was one of your past picks, right? Oh, different ones.
Sorry, is this on Dream Residential or Dream Industrial?
Dream Residential. Yes, you're right.
Yeah, so Dream Residential is an apartment REIT focused on assets in the United States. They have a bit of a focus on the U.S. Sunbelt. They do have some Midwest assets as well. The company went public and has never traded above its IPO price. Most recently, they did take the appropriate step and announced that they would be pursuing strategic alternatives to close the gap. The ticker is DRR.
units. And so I think if you own it, you might as well hold on to it to see how the strategic alternatives proceed, just given the large disconnect between the public valuation and the private valuation.
Okay, we do have to leave it there, but Andrew's going to stick around and share his top picks. That's coming up next. Stay tuned. Welcome back. Time now for our guest top picks. Andrew joins us to take a look at that. The first pick is First Capital REIT on the TSX, and this is something we've mentioned a couple of times through the show, is you like those areas that are sort of grounded by a grocery store for investment.
And that's right. And First Capital has the preeminent portfolio operating in this space. They operate with the highest demographics out of all shopping centers. They have 22 million square feet of necessity-based real estate in Canada's urban centers, half its portfolios in Toronto. And on top of those 22 million square feet of defensive real estate, they have a further 23 million square feet of future development incremental to that retail space. We think today, with the REIT sitting near peak occupancy, there's a potential for a positive inflection in market rents in retail in Canada. We've never had a better backdrop for retail rents. This is a REIT running with internal growth of 4% on a same property NOI basis. They can do 5 to 6% AFFO growth over the next couple of years. And it's all this trading at a 25% discount to its net asset value. So where else can you get the best portfolio of real estate trading at a discount? You can get it on the public markets. And I think First Capital is the poster child for it.
Let me just ask you, because there's been talk of a recession, there's been talk of a temporary pause even in the U.S. I'm wondering whether, I know you said grocery stores as sort of the basis there, as the root there, will help those retail spots. But in general, do you have concerns about a recession bringing down the rest of the retail sectors?
It's certainly a concern on the general merchandise side, on the fashion side, absolutely. But I think a lot of the landlords, it's not lost on them. And the one constant in retail is change. And I think many of the landlords are always focused on how can they replace the weaker part of their portfolios. They all carry bad debt reserves where they expect a certain percentage of their portfolio could go dark. And I think sitting here, the landscape today in Canada, as I said, has never been better in terms of we're coming into a potential recession with very low vacancy, zero new construction. And so while we could see a bit of impact on the demand side, I think the spread that we're operating from in terms of the occupancy levels is quite big.
Got it. Okay, let's get to your next pick, which is Boardwalk REIT on the TSX, and they are mostly, I guess, or focused in Alberta and Saskatchewan.
That's right, and the key there are two words: affordable and non-regulated. You have the ability to invest in a portfolio that is not constrained by rent controls at a time where we've seen higher inflation hurting you as a landlord on the operating expense side. You can move the rents to market, so hence it's a more dynamic market. What's important about Alberta, it's enjoying above average population growth. It continues to, both international immigration as well as interprovincial migration. Boardwalk has affordable rents, think $1,500 rents. Canada's more like $2,200 rents, $2,300 rents, the national average. And of most importance, this company's on sale. I mean, you're buying apartment units in Alberta via Boardwalk at $200,000 a suite, and good luck buying that in the private market. That's going to cost you $275,000 a door, $300,000 a door. And I think the market is being overly concerned as to what the impact of the economy will be on Albertans. People need a place to live, and again, Boardwalk provides a very affordable rent for people to pay.
Okay, let's get to your last pick then, which is Sun Communities. As it says, they focus on Sun Communities, but they also do manufactured housing more specifically in those communities. Tell me more about that.
Yeah, so I keep talking about being defensive. I can't think of a better defensive asset class than manufactured housing communities. Think trailer parks in the United States. This is a land lease business where Sun Communities owns the land, and you, the homeowner, own the home sitting on top of that land. You, the homeowner, pay land rent to the REIT and take on responsibility of maintaining that home. Typically, you see this more on the retirement side. Typically, you see this across the U.S. Sunbelt, heavy concentration in a market like Florida or California, for example. We've never seen a year of negative net operating income growth. It has always been positive, and hence there's never been an opportunity to buy this REIT trading at a discount to NAV, but for select periods of time, and we're sitting within it right now. One of the reasons is they've diversified somewhat away from their core manufactured housing base. They bought marinas in the United States, but lo and behold, just a couple of years later after buying that portfolio, they sold it to Blackstone in a big $6 billion transaction just a couple months ago, highlighting the inherent discount to net asset value in the REIT. We think there's a lot of upside there as it trades at a wide discount. And as I've said, it's a very defensive rent profile.
All right, good to give people some choices. Andrew Moffs, thanks for joining us today. Appreciate you sharing your time.
Thank you very much.
All right, let's take a quick look at the markets before we go. The North American markets looking like this at the hour, 24,817. The TSX up by about 57 points. The S&P is down by 24, and the NASDAQ composite has dropped 226 points at this hour. We'll see you again tomorrow. Thanks for joining us on Market Call.